Hello everyone, welcome back to the channel. Hope you've been well. Today we're going to be starting episode 1 of my series Deep Dives, where, as the name implies, I will be taking a closer look into two separate companies and evaluating them from a perspective of a potential shareholder. For today's video, we will be looking at a company that falls under the blue chip investment category and one that falls under the coin flip investment category. Both of these two companies are in the banking space, so I've got the Financials Index ETF from Vanguard up, which I'll go over briefly. As you can see from this chart, financials have been hit fairly hard since COVID has begun. As you can imagine, this comes from global economic uncertainty and whether companies in this space can manage their capital effectively enough to weather the storm and come out on top in the future. A lot of people were worried that it would be a repeat of 2008, with a lot of people defaulting on their debt, not paying up their loans, and as a result causing some pretty severe economic collapse in the space. So on this chart here, you can see back roughly around late February, you had really big news of the coronavirus really coming out, and then that resulted in roughly about a 45% decline over the next month to down here to 42.8. Since then, you can see it's starting to recover with, news of lockdowns, stimulus checks in the US, and then of course we had big spikes here in the middle as there were vaccine hopes that started to come up. Recently, you can see ever since Pfizer and Moderna released significant news about the efficacy of their vaccines, you can see the financials industry really start to pick back up. And while we're not quite yet at where we started the year, we're roughly at about a 7% decrease. It's still been a pretty strong recovery for the finance sector. So the two stocks that we're going to be looking at today, one I'm sure a lot of people have heard of, JP Morgan or JP Morgan and Chase, ticker symbol JPM, and the other one will be NCINO, which if you follow my portfolio, you'll see that NCINO is part of my coin flip category, ticker symbol NCNO. Here's actually a quick clip of Jim Cramer's from CNBC talking about the financial industry and JP Morgan in particular from July of this year.
But wait, did you just say that this group is you didn't say the word uninvestable, but that's what I heard.
Well, it's not coal, but it is oil. It is oil. It's like oil. I mean, PayPal's good, and that's not a finance company. Square's good.
You own JP Morgan, though, don't you?
I'm wrong. There's First Amendment. I got every right to be stupid. JP Morgan is not the stock to own in this market.
So JP Morgan is arguably the most dominant bank in the US. They've got leading investment banks, commercial banking, credit cards, retail banking, and a whole host of asset and wealth management services. Their scale and scope is definitely the largest in the US, and it's pretty hard to argue against that. They've got many types of different funds under their portfolio. You can see I just clicked on mutual funds. They've got 156 available mutual funds, ETFs. They've got 32 available ETFs, and they've got a whole host of other funds. The investment arm of JP Morgan represents a large bulk of their business. In fact, their investment division is actually the leading global generator of fees. Not to be outdone though, but their banking division is also the largest US money center by assets and tends to have leading share in operations in a lot of the areas that it competes in. When it comes to credit cards, they are the largest and they've issued the most. When it comes to business or commercial, they are also near the top. And then of course you see all their other services that fall under the banking umbrella. You've got your typical checkings accounts, savings accounts, and of course your home loans. And other types of loans. If we pull up the chart here for JP Morgan, you can see how it has performed so far year to date. Very similar to the ETF, you can see from the beginning of the year up here down to its absolute lowest point down here at 79. It's roughly the equivalent of a 45% drop, so very similar to the ETF. But unlike the ETF, it hasn't actually recovered as well as the ETF. It's still trading at roughly about a 12% decrease compared to the beginning of the year. Now, a lot of that, I would assume, is because of the banking division and the uncertainty that is still there. But what's interesting is JP Morgan actually does have a lot of other subsidiaries besides just banking. They've got a subsidiary called WePay, which is essentially a payment services provider, very similar to your Square, Moneris up here in Canada. Essentially, what they want to do is they want to take over this space as well and take over market share from Square. Now, are they going to be able to do as well as Square can do, since Square has such an amazing reputation when it comes to small businesses? It's tough to say, but the amount of assets that JP Morgan has at its disposal certainly makes it so that I'm sure Square should be at least a little bit worried. As you can see here, even on their main page, they go over a couple things. Apparently $1.4 trillion in annual payments back in 2018. They've got access to 4 million different types of small market businesses. Now, these numbers sound really big, but when it comes to comparing it against Square still, it is a very small share of the market. What I would say for Square is they've got that reputation and they've got that software built in, and so it is quite difficult for companies, even as big as JP Morgan, to take that market share away from these small businesses, especially if they've already been set up. Where this also comes into play is it also speaks to the upside of JP Morgan. If we take a look at the financials for JP Morgan, you can see that over the past decade, their revenue has really not changed a whole lot. 2019, the last full year that they had, we're talking 116 billion in revenue, and then if you compare that to 2010, it's 103 billion in revenue. So you can see here, there's just around a 10% increase over the past decade, with quite a few years of down revenue in the middle. So it's really hasn't been growing very much over the past decade. But with the potential of options like getting into the payment space, that does represent an area where they can significantly increase this revenue stream and as a result potentially increase their income. But I will say, if you also do come down here to income, both operating income and net income, you can see have actually increased by a significant amount over the last decade. If we look at operating income, started at $25 trillion with a T, and we're up to about 45 trillion back in 2019 full fiscal year. That represents roughly about an 80 to 90% increase. If you look at net income, 17 billion in 2010, up to 36 billion in full fiscal 2019. That's of course over 100% increase in net income. One other important thing to note is that JP Morgan has already announced that they're going to be spending $30 billion of their cash to buy back more shares. The CEO, Jamie Dimon, really believes in share buyback programs and as providing value for their shareholders, because that's the way that they think is one of the best ways that they can spend capital. And from a shareholder's perspective, you would certainly agree. It shows that the company is confident in their stock. It shows that they're confident in the direction that they're heading, since they think it'll be cheaper to buy back now than in the future. And since it's a dividend paying company, you'll be getting more bang for your buck when it comes to dividend payout time, especially with JP Morgan's history. So they're committing to $30 billion in buyback. And one thing that's very interesting to note is that part of the reason that they announced this buyback program is because the Federal Reserve down in the US, put in a stipulation to all the banks when they were putting in through stress tests that they needed to have enough to cover obviously both the stress test scenarios that they've done this year. So you're going to have companies that are sitting on a whole lot of cash that they now need to find a way to deploy. So the $30 billion is one of the ways that JP Morgan is going to do it, but they've got a lot more cash on reserve that they can do to either invest in other companies or invest in other programs that JP Morgan is running. And as a one-off, what you might see is banks turning that excess capital directly back to shareholders. As you can see from the CEO of JP Morgan, he says here, "We will continue to maintain a fortress balance sheet that allows us to safely deploy capital by investing in and growing our businesses, supporting consumers and businesses, paying a sustainable dividend, and returning any remaining excess capital to shareholders." I think while all those are pretty good tailwinds for the short term and long term, you do never know how things will go in the future. COVID has certainly devastated the economy so far this year, and you don't really know exactly how things will bounce back in the future or if there's even more worse to come. It's also not sure if JP Morgan will be able to continue to be the leader in the entire finance industry, while they certainly are now, and they've been making a strong case that they will continue to do so. Reversion to the mean seems to be pretty much the norm in the competitive banking industry. There's always different market conditions that will allow one bank to start rising atop the other one. So if they start coming back down to the average, that could mean that there's less growth in the future for its share. If we go back to look at the JP Morgan chart at the 5-year price, you can see the significant recovery that it's had since COVID hit, and every time it's making higher lows, which is a great technical sign for it to continue to break up. The price that it's at now, 124.52, has passed any resistance points that it would have had earlier on before COVID, except for, of course, the high that it had earlier on in the year. I don't see any significant resistance up until maybe about the 130 mark. Assuming it goes through that, it should go back and retest what it was at the beginning of the year. I do think that next year will be a good year for JP Morgan. Ultimately, it's not a stock that's going to hit my portfolio just yet, but it is definitely on my watch list, and I will likely add a position at some point in 2021. Next up, we have NCINO, which is a financial technology company, or fintech for short. And the fintech space is one of the most exciting growth opportunities over the next several years as the world increasingly gets rid of cash and banks have to now rely on technology to improve the efficiency of their business. There's been so many times where I've heard, and myself included, have thought that banks are so behind the times with their operating system, with their customer interaction and what you're able to do on their website or app. It's like they've been in the Stone Age. And so fintech is a very incredibly exciting space to be in because they will hopefully revolutionize that space for all the banks while maintaining financial security for your funds. I've taken a short clip from NCINO's main ad, which I'll play for you, just a couple things I clipped together, but it kind of describes how NCINO will operate for the banks and the benefits that they provide.
The NCINO Bank Operating System. Built by bankers for bankers, NCINO streamlines all business lines and customer interactions within a single secure cloud-based solution. How would your institution benefit if you had a single banking system where everything was in one place?
So if we look at NCINO this year, it IPO'd back in July 14th, meaning it came out for its initial public offering where it was able to be traded at the stock market. It IPO'd for $31, but it actually opened at an incredibly high $91, meaning it almost tripled in value just from opening. It did come, quote unquote, down to earth at 72.34 and 68 very shortly after the next couple days, but that's still over a 100% gain from its IPO price of $31. As you can see, it's had a very bumpy ride since then, going all the way up to $98 at one point, before coming back down to roughly about 69, and then up and then down, back to about 78, 68, where it's at now. So if you want to get into something like this, this is definitely going to be a significantly more bumpy ride than the JP Morgan stock that we just talked about earlier. It's part of what makes it a quote-unquote coin flip stock for me. But, let's talk about what they do. Basically, like we said, they just came out back in July, so it's only reported about 2 quarters worth of results. NCINO is a SaaS business, which is the hot term right now, which SaaS is basically software as a service. So their model is charging their software, which, as you heard through the ad, is their operating system, but they charge it as a service to their customers, which in this case is the bank. So essentially they will charge a monthly subscription or perhaps an annual fee to the banks for letting them use their software. So if we take a look at what NCINO does, is they sell this bank operating system. The long and short of it is that it basically uses artificial intelligence, or AI, to improve the efficiency and effectiveness of banking operations. It's supposed to be a seamless platform that's accessible from anywhere that just has internet, and it's supposed to really improve the banking experience for customers as well as the banking experience for internal employees. Currently, they service about 1,100 banks. So some of the clients that nCino has is that they got Bank of America, TD Bank, and Regions Bank. It's used by quite a few of the big players in the industry for their technical needs. Now, the statistics that they have are pretty impressive. If we go to benefits and values, they do list some of their benefits here. It says here that profitability for the banks have increased, 17% reduction in operating cost, 19% increase in revenue. They cite stronger relationships and a greater competitive advantage. For efficiency, they've got reduces regulatory prep time is a huge one, and that results in roughly a 22% increase in staff efficiency. Some of the other figures that I pulled off their report, they've said that in terms of growth for the bank, they saw account application completion rates, basically customers who start an application and finish the application, that improved by about 127% while reducing the service cost by a lot. So the core of their business is primarily a subscription business. That's what they're focused on growing right now. Recent numbers, you can see, total revenue grew by about 43% in the last quarter, according to their quarterly earnings report. Subscription revenue is up about 56%. So that's obviously a really good ongoing trend that you want to see. Now, it's also worth noting that their operating system is based on the Salesforce architecture. All these dashboards and everything that they've got going on, that is the exact same as what Salesforce looks like. And if we go back to how it works, you can see clearly that basically they get the application with the client onboarding, whether it's through the account opening or the loan origination, and then it goes through the nCino platform and the nCino IQ. But you can see clearly from this integration screen how Salesforce is completely all in on this business. They use a lot of the Salesforce software directly using actually the exact Salesforce software. And even if it comes to stuff like security, you've got Salesforce backing it. So they do, although they aren't owned by Salesforce by any means, Salesforce does have a 12% stake in nCino. From a perspective or current shareholder of nCino, you can kind of picture how the evolution of this company might go. There might be a time in the future where Salesforce just completely buys out nCino, especially if they already have 12% ownership of the company. Now, it's important to note that nCino isn't the only company that's doing this for banks. There are other competitors out there, but when you have someone as big as Salesforce backing you and using Salesforce's platform, that's a huge competitive advantage for you as a startup company. Now, if you want to go back to the benefits of how nCino might actually be useful, we can just take a look at Bank of America. Bank of America is probably the most tech savvy out of the main banks in the US. And I don't think it's a coincidence that you're seeing Bank of America being one of the quickest to grow over the last couple quarters since they've adopted the nCino platform. Now, as we said with nCino, basically what they've got right now is, besides Salesforce, they've got a really big first mover's advantage. There are, I'm sure, going to be many companies that will also be trying to do the same thing, but we'll see how long nCino can maintain its first mover's advantage. They've got about 1,100 customers right now, but there's a total of about 5,000 or so banks in the US, and of course they will start to expand globally once they are able to. If we take a look at nCino's financials, there's estimated and actual earnings per share as well as revenues. Some of these are going in a not so great direction. As you can see, the earnings per share is actually expected to decrease next year. So that is certainly not a great thing. This is a result of their operating margin likely going to be getting worse or perhaps staying around the same, their net margin perhaps staying around the same. But what this really shows is that they're going to be spending and burning through a lot of cash trying to grow as quick as possible. Their revenue is estimated to increase. And as you can see from 2018, 2019, 2020, they're seeing very significant or pretty significant year-over-year growth, which is why there's actually quite a bit of a huge premium being put on this stock right now. If you take a look here on investing.com, you can see the price to sales ratio for NCINO, price to book, and price to tangible book. And as you can see, I mean, it is trading at a significant premium compared to market or industry average. But of course, you're paying the price premium for it being a disruptor in the industry, it having first mover advantage, the significant year over year or quarter over quarter growth that you're seeing. But as you can see, there is a lot of risk that is built into this company right now if you were to invest. So I've only taken an initial starter's position in this company because I do want some shares. If it ever drops, I will continue to review the quarterly earnings to see how the company is doing and executing its game plan. And if it's still doing the same, then I will likely just purchase shares at a cheaper price to build up a bigger position. But certainly right now, at least I've got a foot in the door, and if it continues to do well and go up, then at least I'll have some position and I'll probably add to it, even if it goes up or down as the story and the narratives develop for NCINO. I believe in the long-term outlook of this company. It will not surprise me if it is an extremely bumpy ride from now over the next 3 to 5 years, but that is how long I plan to hold this stock, at least roughly the next 3 to 5 years. So I'm sure there will be many buy points that will allow me to get prices at a significantly cheaper price. And if there really isn't, then at least I'll have got in early. Hopefully you guys liked the video. Leave a like, comment, and subscribe if you did. Let me know what other companies you might be interested in reviewing going forward, and I will chat with you guys next time. Bye.